And we're back. Welcome, Joe. How you doing?
Doing well, Nick. Thank you for having me on.
Yeah, so this particular episode, we're going to be getting into some of the details around rating agencies, the importance of them in the insurance ecosystem. I happen to live in Florida. It's a vital service that occurs. And so speaking with was it founder of Demotech, founder and CEO?
Yeah, your co-founder, myself and my
Co-founder.
wife, Sharon Romano Petrelli.
Oh, that must make for really interesting dinner conversations. The
Yes.
best. Joe, we start all of these. Why don't I give you an opportunity to do an elevator pitch? Who are you? What is Demotech?
Well, I thank you. I think Demotech was incorporated September 9th, 1985. So we're approaching our 40th anniversary here fairly soon. We originally started out to provide actuarial services to insurance companies because the advisory organizations were moving to loss costs from advisory rates. And so we thought that the smaller companies from coast to coast would need actuarial assistance. We did that for several years. And then in 1988, we found out that Fannie Mae and Freddie Mac were looking for someone to review and rate independent regional and specialty insurance companies. And we found out about that. We applied, if you will, by sending in our materials. And we eventually, between Fannie Mae Desk Review, Fannie Mae Independent Consultant, Freddie Mac Desk Review, Freddie Mac Independent Consultant, we were approved by both organizations. So we were the very first to review and rate independent regional and specialty insurers that did not have a huge parent. If they had a huge parent, the other rating agencies would kind of include them in the group, but we were the first to actually review and rate the smaller companies.
Does that mean that before Demotech came along, those independent, those smaller firms, did they not have any rating?
They had no third party rating that was publicly available. What Fannie and Freddie would do is Fannie and Freddie would do a desk review and approve a company internally. And eventually they got to the point where they said, you know what, it's kind of like grading our own work because we're approving the insurance company that's protecting the properties that we're going to use to collateralize an obligation to the public. We don't want to grade our own work. We need somebody else to do it. According to Anita Champ, who was with Fannie Mae at the time, Fannie Mae single family, she was the one that coordinated our due diligence. She had approached AM Best, and AM Best told her it was impossible. That those were their words. She actually published an article saying that it was impossible to rate these companies. We developed the process to do it, heavily focused obviously on reinsurance because they're smaller companies. But yes, we were the first, and up until that point, Fannie Mae and Freddie Mac were doing desk audits.
I did not know that. I was kind of under the assumption that every insurance company needed a third party rating, but that must be the value proposition that Demotech brings is until you came around, they weren't existing, and now you're filling that niche to allow even the smaller firms access to that kind of symbol, right? Because it's hard to do business without a third party giving some kind of credence towards their ability to pay claims.
Yeah, I think that's certainly true. We've seen it over time, 1980s to now. We've seen it morph. We've seen rating requirements, obviously, in lender agreements. We've seen them in vendor agreements. We've seen them in insurance agency and O policies. And, in early 2000, ratings were imposed in in insurance agents errors and omissions professional liability policy where the insurer would say, we will provide defense if the company goes under that you, Mr. or Ms. Agent, have recommended, but only if it has a certain rating. And the reality is there was only one rating agency included in those for the longest period of time. But we spent a few years contacting the E&O carriers. And so as we sit today, there's now two rating agencies in virtually every E&O carrier's uh, requirements.
Yeah. Can you help? I actually don't know the answer to this, so I think it'll be helpful for the audience. The difference between advisory rates and loss costs?
Well, I think advisory rates way back when they would actually publish ISO, AAIS, NCCI, probably MSO. They would actually publish a rate based upon the loss cost, the frequency and severity of loss, and then they would have publish a rate that reflected sort of average expenses, if you will. And they would say, if this was your loss experience and these were your expenses, this would be our recommendation to your rate for a rate, and then companies would deviate from that, usually 5, 10, 15, 20%, depending upon the situation and how they felt their underwriting and or expense ratio would contribute to a lower rate level. And then it's around the mid 80s, the advisory organizations just did away with the expense portion of the premium and basically
Mhm.
said, here is the loss cost, which is essentially the loss portion per policy, if you will. So you have to load it up for your own expenses. And so the loss cost you would look at as the average loss per policyholder.
Yeah, I didn't know that, so that's really good to understand, and I will put additional information in the show notes about that in particular. Can you go into a day in the life of someone at Demotech or any of the rating agencies? It doesn't matter. Can you sort of summarize like what the process entails? It's not, I mean, there's a reason why people want third party folks to take a look at it, and you take your work very seriously. So this isn't like someone just sliding you a few balance sheets or income statements. There's a lot that goes into it. Can you give us a glimpse of the
Sure.
Herculean effort that you guys take? I'm
Well,
going to make you into the big muscular Italian.
all right. Well, I think it is well, I will say this nowadays with the access to electronic data, it's appreciably less paper pushing than it used to be because now we have a data vendor that can provide decades of annual and financial and quarterly data. So the process of having the big yellow books or the blue books for life and health or the salmon colored books for title insurance laying all over your desk, those days are kind of gone. But the key is accessibility of data. And if I could make one distinction early on between the way we look at the world and maybe the way the others rating agencies might, we specifically call our ratings financial stability ratings.
Mhm.
I think you'll see other companies might call them financial strength ratings or financial ratings. We believe that stability is important, particularly when you're looking at some of these regional and specialty carriers that we rate. Many of them might operate not just in one state, but maybe in 10 counties. And so the focus is on stability because we want them to stick to what they know, stick to your knitting. And when other rating agencies look at diversification, whether it's geographic diversification or line of business diversification, we would much prefer that someone sticks to their knitting than gets heavily involved in a line of business simply for the sake of diversifying because a rating agency might suggest that diversification is the way to go. Yeah, I mean, if you look at it within by analogy, you look at like medical specialties. I'm not sure I'd want a hand surgeon to be doing my heart. And so, yes, they could diversify, but they're better off becoming experts at what they do. So we think the concept of stability is important in ratings because it implies that you're sticking to those things that you know and you're looking for consistency over time.
So how would then, I'm just curious, how would a firm like Demotech with stability rating? Because I'm a believer in diversification. Kind of don't get trapped right in your little area. When you said that the firm that maybe has 10 counties in a particular state, I naturally cringe because I'm thinking one event could hit all 10 counties we should spread out a little bit. So what would be what would be a mechanism that you think fits? Because I hear what you're saying, and I also understand that companies that diversify geographically also experience problems as well. It's not smooth sailing because they're going into markets that they generally might not have already gone
Yeah.
into, so they don't have that expertise. How do you think about that?
Yeah, I think, well, let's be realistic about it. Let's talk about the diversification to begin with. If a company is in 20 states, there still can be an argument that they need to diversify in because there's 30 they're not in, right? So where do you draw the line on diversification, I think is one thing. But to specifically answer your question, all right, you got this, let's take a company with 10 counties in one state, and that's really where they have the overwhelming 90 something percent of their business. We've seen that. That's where the importance of reinsurance comes in. And that's one of the things that we brought to the table in 1988, 1989, when we were discussing our rating process with Fannie Mae and with Freddie Mac. So the important thing from our perspective is when you have that concentration, whether it's a catastrophic concentration or whether you have a size issue and you need to have a relatively low net retention per risk, even if you on a casualty basis, for example, you won't necessarily have a cat, but you'll certainly have to have a relatively low retention. The thing that we see happening is because those carriers, those smaller carriers, are so heavily dependent on a reinsurer's participation, you will find them to be appreciably more disciplined in their pricing because they can never afford to lose the reinsurance. It's not like they're going to have $1 million policy and they're going to have 500,000. No, they're going to have 25 or 50,000. The same thing happens on cats. To your point about the 10 counties, we have in place our general requirement is no more than 10% of surplus exposed to one event. So it gets pretty restrictive. So so if you have multiple events and you could you talk about Florida, 2004, 2005, there was, I think, back to back eight named hurricanes. You look at things like that. If you're losing 10% of your surplus every time, it's no fun for the company, but at the same time, it's manageable and you're not going to be totally depleted. Whereas if you had someone that had a more aggressive retention, say 20 or 25% of surplus, then you're going to have a problem when you have a catastrophic event. And I think between our relative conservatism on the net retention during the cat event and some of the advances that there's been in catastrophe modeling and the assumptions underlying catastrophe modeling, the amount of data available to the catastrophe modelers, I think it presents a fairly conservative net exposure in the worst case scenario. And that's why I think that the concentration in a particular geographical area doesn't trouble us as much as it might other rating agencies. It's because we're doing that deep dive on the reinsurance.
Yeah. So who is it the reinsurance broker of the carrier that's providing the modeling? Does the carrier do the modeling? Do you do the modeling?
No,
The
well, no,
catastrophe modeling?
we do not do catastrophe modeling. We do stay in touch. Our analysts are in touch with major cat modeling organizations every year, kind of learning what's new. They might have a sit down meeting. Some of them come to visit us. Other times we use a Zoom or a go to meeting or a Teams. So we're in touch with them. We want to know what they're doing. But usually what will happen is most companies will run two or three cat modelers. So we're looking at both. We're talking to them about, what they're doing in-house, what the broker's doing for them. And we have a pretty good understanding of not only the model they're using and the version of that model, but we're also telling them, regardless of what you look at, we want to see that. But here's a few things we want to look at. We want to look at all systems, all switches on. We want to look at, at least a 1 in 100 year event, 1 in 130 year event for the first event, 1 in 150 for the second event. want you to have reinsurance placement protection in place. So we're looking at a scenario where, there's going to be multiple storms in a year. It's not just one big one and done. It's about the season.
Yeah. Yeah. So the reinsurance component is quite interesting because, as you said, and this is probably a good transition into Florida domestics. There's I was speaking to someone on the phone yesterday that was saying, "Do you know how easy it is to stand up an insurance company in Florida? Like just to get the license, it's so much easier. The capitalization that's required is a lot lower. There's the expectation of significant reinsurance support." And that's probably why Bermuda is so wealthy, is because of the state of Florida. Um, yeah, can you explain to the audience, the folks that, I mean, we can go into like definitions of what reinsurance is, but the reinsurance component becomes, I think, critical for the companies that you're focused on and the companies in Florida because they're so lightly capitalized, which means you have to keep an eye on the reinsurers too. Like you have to know if the reinsurer is of quality, like what's their capability of paying. So you have
Yes.
basically two claims paying entities, or probably more, because it's probably more than one reinsurer that you have to keep tabs on. And so you're juggling a gross and a net exposure that's seems like a big bridge, especially for the smaller firms, especially for the Florida domestics. Can you talk about the importance of reinsurance and how much of your time goes into understanding the reinsurance treaties for some of these companies? And I've seen some of them. It's like Legos. Like how do you make sense out of all of them, and how do you do it within a reasonable time? So you can get your rating out.
Well, I think well, two things. First is we do even though the larger reinsurers and virtually all the bigger reinsurers are publicly traded, they're reviewed by three or four of the other nationally recognized statistical rating organizations. We still do our own review. So we're not just taking, another NRSRO's word for the reinsurers. So we're taking a look at them. The advantage you have is there's a relatively small number of them that participate in the cat world. So that piece of it, I think we got a pretty good handle on that. And we're also fortunate. One of our analysts been with us, I think, going on 18 years. Bob Warren is a CPA inactive and a CPCU, and he's been the CFO of three different companies. And it was always Bob's job to tell the board, if the wind blows and when he was the CFO of a company, what's the maximum check we're going to have to write and how much do we get reimbursed? So Bob's been doing the reinsurance reviews. He streamlined that process, and we have a series of exhibits that we send out each year, and we do a preliminary review. What do you want your program to be? What do you think it's going to be? What do you think the terms are, the cost? And then we'll get a final review. And sometimes we'll say you might need a little bit more reinsurance based on the modeling you gave us, but we're always comparing the modeling that's been done, the assumptions underlying that modeling, to the program that's being purchased, to our own minimum requirements that are published. So but it has been standardized so that we can have that conversation. The other thing I will say is over time, and when I'm talking, let's say 2010 versus now, the CEOs and the CFOs of the companies today much more inclined to know the intricacies of that reinsurance program than they were 15 years ago because they're spending a lot of money on it. I mean, for some of these companies, 60% of their premium, maybe even a touch more for some of them, it's going to the reinsurer. So they're very cognizant of what that reinsurance program is and does. They're always looking at rate adequacy because they know they got to give 60 cents out to the reinsurers. And I think that as we sit today, the reinsurance component in Florida gets more scrutiny than anywhere else. And it's helped everyone understand the cost of insurance for the Sunshine State.
How do you guys handle alternative reinsurance vehicles like cat bonds or a sidecar. I'm assuming you go through the same thing, and a cat bond would have a rating associated with it. But man, it's even more Legos into
Yeah,
the tower, you know?
it is. I think the cat bonds are nice. We review them, but they're nice once, right? It's you kind of look at a cat bond, especially at the top of a program. You look at a cat bond, it's kind of one and done. So what are you doing with the next event? And so you look at the cat bonds the same way. If someone wants to use cat bonds for 3 events, then they better be ready to understand and describe to us how those cat bonds are going to be triggered. The other thing you want to make sure is that the triggers in the cat bonds are the same as the triggers in the underlying program, right? And so we watch that. We also look for basis risk. If there's any risk that, so when you get into parametric covers, we're willing to talk about parametric covers, but we want to see what the basis risk is. If somebody's going to get 95 cents on a dollar for a parametric layer, how does that 5% that's missing when you look at the company's
Yeah.
surplus and the net retention, you have to look at that dynamic as well. And we've done that. We've been involved in Florida since 1996. And our analysts, Barry Kessler's our chief ratings officer. He's been with us since about that time. Bob Warren's been here 18 years. Doug Powell's been here 18 years. And we've been in Florida, going on 28 now. So when we start talking about how to review catastrophe reinsurance and cat bonds, we've got guys that have been doing that for a decade, in the cat bonds area, and for 2 decades in the Florida marketplace and reinsurance.
When you look at the last few years, which have been incredibly volatile in the wrong way, in the wrong ways, so to speak, you were very vocal about the issues that the Florida insurers were running into. Can you take us through like the past decade of activity? Because we had a very quiet phase of no hurricanes, right? And yet we get to the end of the decade and we get two, and all of a sudden there's this litigation boom that's occurring around it. How does Demotech or how do rating agencies think about that compounding effect? Like that takes a catastrophe and adds like kerosene to it, the last thing that we need. But how do you think of that? Or did you see this coming from like a mile away?
Well, the disparate, disproportionate litigation, I think that's been documented. When David Altmaier was commissioner, he documented that in his own observations and recommendations to the state of Florida Senate. I know there was a letter dated April 2021, I believe, where he was talking about the disparate, disproportionate litigation. I mean, I think at one point, rough cuts, Florida represented 8% of the homeowners' claims in the country, but yet it represented something like 75 or 80% of the litigated homeowners' claims in the country.
Yeah.
So it was disproportionate. And I think well, I mean, if you're an actuary, that's all the wrong things, right? You're extending the tail because litigated claims take longer than other claims. You have a storm blow through, and the next thing you have 200,000, 250,000 potential litigations because, nobody's going to be happy because they have to wait to, somebody gets to them to talk about their claim. So you always have that. You've always had litigation in the insurance industry. You always will. There's going to be differences of opinion, but the disparate litigation, I think that fortunately in December of 2022 and the spring of 2023, I think, Governor DeSantis and CFO Petronis got what they needed and wanted in terms of the reforms. Unfortunately, they couldn't get them through in May of 2022 special session because they had some resistance from the leadership in the House. But certainly they were on the right track. They knew what they had to do. And I'll be quite candid with you. Yes, we were vocal in 2022 and 2023, but I guess I must have forgot my civics courses from high school because I never realized how much control a Speaker of the House would have to thwart the good efforts that the governor was making in May of 2022.
I think that happens with every speaker. I think they have that power. So
Yes.
yes, they are pretty powerful. Um, in terms of, I'd like to kind of finish off in two ways. One is a general forecast for Florida. It's tough to say whether the reforms are going to work or not, but it does seem like we're getting enough. Does seem like there's enough rating support now that Bermudian reinsurers are willing to kind of come back in. So we're seeing some citizens takeouts, seeing some new entities get stood up, which I'm sure Demotech has been introduced to them. It does seem like, at least from a confidence standpoint, folks are willing to bite the bullet here and say, we think these reforms are going to work. We're willing to take a chance. We'll dip our toe in the water to kind of
Yeah.
test it out. What is your sense of that?
Well, I think certainly the reforms that were put in place are are working from the companies that talk to me and from what I read in the insurance press, the reforms seem to be working. I think there's sort of a pig in the python, if you will, with there was, I think, 280,000 claims that were filed in early 2023 just to kind of get through a timing provision to kind of get in line. From my perspective, what's my view of the long haul? I think the reinsurance rates have stabilized. And so we're not going to see 25, 30% rate increases anymore. We're going to see more reasonable single digit to maybe low double digit rate increases, which I think are much more manageable. What I see, and this is my personal prediction, it's not necessarily a Demotech prediction, it's the actuary in me. There is going to be a period because insurance rates are based on historical data and historical situations. There's going to be a reinsurance cost and a claim litigation cost is sort of a pig in the python. And as those start getting pushed through, those are going to manifest themselves in the forms of rate increases that are likely to be more than the future rate increases are. So I guess I believe there's going to be perhaps a period of relatively high rate increases to kind of get that past experience reflected, and then there'll be lower rate increases. But I'm not, on a personal level, I'm not a believer that rate decreases are really in the cards.
Yeah, I think that's a fair forecast. Thank you for that. And Florida's not the only state. So yeah, I happen to live in Florida, so I'm going to be selfish and sit on that for a while. But we're starting to see issues. Well, we knew the other Gulf states were having problems before. I think anything that's coastal has some issue that's associated with it. But interestingly, now we're seeing issues with wildfires out in the West. California seems to be like where Florida was a couple of years ago. There's still a regulatory legislative tension and drama with the insurance companies on how they're supposed to do their work and do their business, which can't imagine would be amenable to how a rating agency would want them to do it. But Colorado is also having some issues as well with lack of capacity. So, given your national exposure, when you peer across the country, are there states that we should be concerned about? Am I right? Like California still might have 2, 3, 5 years of kind of tough sledding before the system cleans itself out?
Well, I mean, just in terms of our ability to look at something nationally, we review and rate approximately 460 companies, coast to coast, Alaska, Hawaii, Puerto Rico, and out of the 460, more than 420 are not Florida. So I mean, they're less than 10% of the companies we review and rate. So we do have a lot of clients in some of the Gulf states and we have clients in every state, or at least writing in every state if they're not domiciled there. what we're seeing, Nick, is we're seeing some degree of litigation activity that's actually uses natural disasters as ground cover. So I think when you start looking at states where there are going to be where there are natural disasters, you have floods, you have wildfire, you have earthquake, you have hurricane, but you also have tornadoes, hail. I mean, the Midwest is not, might not have the earthquake exposure of a California or the hurricane exposure, but it's got tornadoes, it's got hail, it's got huge lightning, it's got flooding possibilities. And so I think anywhere those secondary perils, people are more concerned now. And I'm more aware of the cost. And I think from my perspective, the other thing that we have to figure out, we being an industry, not a rating agency like us, but we as an industry, how do we make people understand that a lower cost product is also a less coverage product? And I think there's companies out there that are focused on, here's what you need. If you can't afford it, don't buy it. But this is what you need. I'm not going to sell you less because it doesn't give you what you need. I think that somehow all parties have to start to move to that and make people understand, if you're paying less, you're getting less.
I think there's a relatively lack of understanding all across the board around what insurance is and how it's supposed to work, Joe.
Yeah.
Consumers, I don't know, have you ever, what am I asking? Of course, you've read a policy form. They're difficult to read,
Yeah.
right? Like I struggle with it, and I'm a professional, and
Yeah.
I'll kind of go through it, and it's just like, who wrote this? What is this?
Well,
So, but you see it magnified through the media, like insurance is an easy business to pick on because I was having this conversation with Wesley Todd of Case Clyde a couple of weeks ago, where, a single company might have 10,000 claims, right? To expect all 10,000 claims to be closed effortlessly, like,
yeah.
with satisfaction on the other side, that's too much to ask.
Yeah.
So out of 10,000, you're going to get a percentage that are upset.
Yes.
They don't think it's fair, and they begin vocalizing that, and they get all of the publicity. But in most of these cases, you must see this with your client companies. Most of the time, the claims are closed, and they're closed quickly.
Yeah.
And I mean, is there like full, like delightful satisfaction? It's hard to say, but it was a very stressful moment for everybody in that situation. To get 90+% nice, clean, and closed
Yeah.
and back whole, I think shows the amazing invention, the technology that insurance actually is. And I think people do misunderstand it. The media, everybody.
Yeah. I mean, this is, just to kind of, and again, I'm an actuary. I'm not an operations person. I don't have to do, kind of the real work of getting the policy out. But one of the things that I thought about, we talk about how difficult it is to understand a policy, is you can buy a basic policy, a BOP, a professional liability, whatever it might be, and you go out and it's got 50 endorsements. Well, don't we have the capability through word processing? Why not just put those endorsements where they belong within the policy? So you actually have a policy that reads coherently from page 1 through the end of the policy, right? And instead of saying, here's a page that's got the 13 special provisions that each state, here's the Arkansas provision, the California provision, the Delaware, put it in there in Arkansas, put it in there in California, put it in there in Delaware, and let somebody have a policy that actually reads from cover to cover. Maybe, I don't know. I mean, they're just the technology that we have available is, maybe we got to spend a little bit of that money on making the customer experience more important than than it is today. I think the customer experience, not just the policyholder experience, it's the claimant experience. At the end of the day, I think you could actually philosophically make the case that your customer is not a policyholder. Your customer is the claimant. And I think if we start looking at the world, why would you cancel somebody who's got a claim because that's what they bought the policy to cover? So I mean, there's all sorts of things where we get a bad rap, and part of them is because we're looking at things from our own perspective. And I'm not saying the other guy's 100% right, but I'm saying the other guy's got an opinion. The claimant and the policyholder's got an opinion.
Yeah. And I think that's what we're trying to accomplish with this podcast and the content that gets produced from here is to shed a light on this. But this is not, we are pro insurance carrier. I think there are a lot of cases where they're getting taken advantage of. And I think there's a lot of cases where they have just poor business practice. For the most part in my career, Joe, I've never really seen anything egregious. I just seen like you've seen mismanagement here or there, or things fall through the cracks. 10,000 claims might be 1,000 more than they can possibly handle. They were not prepared for it, and things fell through the cracks. So stuff happens.
Well, I'll go back to when you're talking about our review of catastrophes, and we also, when we're looking at companies that have catastrophe exposure, we ask for their disaster recovery plan in case their home office gets hit. We ask for their catastrophe response plan, and we actually get pretty detailed because there was one point in time, and again, I'm going back 15, 20 years, where in Florida, everybody had the same cat response contractors, and everybody was promised that they're going to be number one. And it's like, I got to be honest with you. You can't all be number one, right? To your point about getting to the claimants quickly. And so you look at this and, you eventually develop a methodology and you apply it consistently. And you're right. I mean, there's a lot of things that our industry does that people within it say, all right, I get it, but there has to be a better way. And I think, for example, today, if any insurance company has an answering machine over the weekend, I think you're asking for trouble. Right? I mean, you just take turns being on calls.
Or insurance agencies.
Yes. Yeah. Thank you.
With the technology that exists when it's on the weekend and I'm looking because the auto prices in Florida exploded as well. And I'm looking around trying to get quotes for auto, and it's Saturday and nobody's answering the phone. Nobody's there. No one's answering email. It's like, but you have technology. I'll quote it myself. I'll self-serve myself, but at least make it available to me. So I hear it. I think, listen, Joe, this was a fantastic summary of rating agencies. I want to leave the door open to have Demotech on again. And I think we want to do the right things, right? And it's clear, the rating agencies have an opinion and a perspective on what a strong insurance market is supposed to look like. And part of what it is that we're trying to do is tear down those silos so that we can have these conversations.
Yeah.
We can have smart people across different areas kind of point out, hey, that's broken, right? And how do we fix it, kind of thing. So I think Demotech plays an incredibly important role. As a matter of fact, if it wasn't for Demotech, there would probably be billions of dollars of insurance capacity that would not be in the marketplace today without Demotech acting as the third party. So Demotech plays an incredible role in creating wealth, in the value creation of the country. Because of what you do, that capital would go somewhere else. So Demotech is extremely important. And thank you for elucidating and shedding light on what it is that you do.
Well, thank you. I think we look back and we look at not only the claims that Demotech rated companies have paid, the reinsurance they've ceded to reinsurers, but also the commissions they've been able to pay to producers who've earned, that money by helping consumers. It's a value chain.
Yeah. Yeah. And the employees of the carriers.
There you go.
Those carriers wouldn't exist. So fantastic. Thanks, Joe. And again, doors open anytime.